Okay, let's unpack this. We're talking about an investment yield that clocks in around, what, 11%?
11%, yeah, serious.
Seriously, in today's market, where finding any decent income feels like a real struggle, especially for those big tech giants, the Nasdaq names.
Yeah.
That number just leaps off the page.
It absolutely does. And that headline figure, that compelling lure, is exactly what we're diving deep into today.
Right.
We're focusing on the JPMorgan Nasdaq Equity Premium Income ETF. Most people just call it JEPQ.
JEPQ, okay. So we've looked through a bunch of material you send over, articles and research notes, all zeroing in on this one ETF.
Yeah.
And our mission here is pretty straightforward, but I think critical.
Yeah.
Cut through the noise, right?
Absolutely.
We need to figure out what JEPQ fundamentally is, how it manages to generate that really high yield.
Yeah, it is high.
And maybe most importantly for you listening, what are the real costs? What are the trade-offs you need to understand?
Exactly. It's about getting past that shiny number and finding those important nuggets of knowledge underneath. Seeing 11% is one thing, but understanding the engine.
And what you might be giving up.
Precisely. What you might implicitly be giving up to get it. That's the real value here.
So let's start right at the beginning.
Yeah.
The basics. What is JEPQ at its core?
Okay. So JPQ was launched by JPMorgan. That was back in May 2022.
Right. Relatively new then.
Yeah. And you can kind of think of it as a specialized sibling to their other very popular ETF, JEPI.
Oh, JEPI. Yeah, lots of people know that one.
Right. So while JPI focuses on the broader S&P 500,
Right.
JEPQ zeroes in specifically on the Nasdaq 100.
So the tech-heavy big brother, you could say?
Sort of, yeah.
Okay.
And its core strategy is something called an equity premium strategy.
Okay, equity premium. What does that actually mean in practice for someone investing?
It means JPQ is essentially doing two things at once. First, it holds a portfolio of stocks.
Right.
And because it's tracking the Nasdaq 100, that means owning those familiar tech companies, Microsoft, Apple, NVIDIA, some of the big ones.
Okay, got it. So it owns the basic tech stocks. That makes sense. Then comes the income part, the premium part.
Exactly. On top of just holding those stocks, it then uses covered call options.
Overcalls. Okay.
Yeah, to generate extra income. One of the sources we looked at put it in really good plain English.
Oh.
It said JEPQ owns the tech companies, but sells upside via call options to generate income.
Sells upside. Huh. That's pretty concise.
It is.
And there's that analogy in the material too, right, about renting.
Yeah, that was a great one. It's like renting out your growth stocks to others who think they'll go even higher.
Okay.
Collecting the rent, that's the option premium, and using that rent to pay investors a fat dividend.
I like that. Renting out your stocks.
Yeah.
It really kind of crystallizes the mechanism.
It's a brilliant comparison, I think. And that rent, those option premiums from selling the calls,
Yeah.
that is where the vast majority of that 11% yield comes from.
Ah, okay. So it's not really coming from the dividends the tech stocks themselves pay out, because those are usually pretty small.
Exactly. Those are minimal, often negligible, really, compared to that big headline number. This yield is manufactured.
Manufactured. Okay. So let's break down those two pieces of the yield then, just like the sources do.
Right. So you've got the standard dividends from the Nasdaq 100 stocks JEPQ holds.
Which are tiny, we just said.
Tiny, often less than 1% a year, according to our sources.
Okay. Minuscule part of the pie.
Precisely. The overwhelming bulk, almost all of that 11%, comes from the income generated by writing those covered calls.
Right, the rent. Now, the sources mentioned they use something called ELNs, equity-linked notes.
Yes, ELNs.
What are those in this context, and why use them instead of just selling options directly?
So think of ELNs as basically special debt instruments. Their payout is linked to some underlying asset.
Okay.
In this case, it's linked to the Nasdaq 100 stocks and the option strategy being run on them.
And why? What's the benefit?
The sources suggest it gives the fund managers flexibility, maybe in how the income gets treated for tax purposes, or maybe it makes executing the option strategy more efficient.
Interesting. So it's kind of a structural thing behind the scenes.
Yeah, a layer to help facilitate the strategy smoothly.
And that income, mainly from the option premiums via these ELNs, gets paid out monthly.
Right, distributed monthly. And that gives you that high trailing 12-month yield number that grabs all the attention.
That 11% figure.
Exactly. That's what it's paid out over the last year. But the sources are really clear. This yield comes at a price.
Okay.
And they don't just mean the expense ratio, which is 0.35%. I mean, that's reasonable for this kind of active strategy, but it's not zero.
Right. There's always a fee.
Yeah.
But what's the real price then?
The real cost is the opportunity cost.
Wow. The potential upside you give up.
Exactly. This is honestly where this deep dive gets really crucial, I think.
Okay, let's lay it out. This big trade-off. Income now versus potential growth later.
Right. Think about a standard Nasdaq 100 ETF, like QQQ.
Yeah, it just tracks the index.
If you own QQQ and the tech market just surges, maybe there's, I don't know, some huge AI breakthrough, or the Fed pivots.
Right, something kicks off a rally.
Your QQQ investment participates fully in that upside. One source used NVIDIA as an example. If NVIDIA jumps 50%, the QQPQ investor gets that full benefit.
Total, uncapped participation. Makes sense.
Right. Now, contrast that with JEPQ. Remember, it sold that call option.
The renting out part.
Yeah, it collected the premium, the rent income. But if the stock price rockets above the strike price of that option, the buyer of the option gets to buy the stock at that lower price.
Then JEPQ, because it sold that right.
It has to let that upside go. It keeps the small premium, but it sits on the sidelines, as the sources say.
Wow.
While the upside is handed off to someone else.
Okay. That really clarifies the trade-off. It boils down to, in essence, you're trading growth for income.
That's it. And this strategy, it really shines in certain market conditions. Like sideways markets, when things aren't really going anywhere fast. Or maybe markets trending just slightly up or slightly down.
Okay, not ripping higher.
Exactly. And it can be a money printing machine, according to one source, when volatility is high.
Why high volatility?
Because option premiums, the rent, get bigger when markets are jumpy.
Ah, okay. But what about the opposite? When the market's in one of those, raging bull phases.
Yeah.
Especially in tech.
Well, in those situations, the sources are pretty blunt about it.
Yeah.
You lag. Hard.
Ouch. Lag hard. And we actually have performance data from the sources to back this up, right? Not just theory.
We do. Let's look at the comparison period they used from when JEPQ started in May 2022 up to May 2025. So just under 3 years.
Okay, almost 3 years. What did the numbers show? JEPQ first.
Over that time frame, the cumulative total return for JEPQ was roughly 14%.
14% total return. And the sources noted a lot of that was just the reinvested income, right?
Yeah, a significant chunk came from reinvesting those monthly distributions.
Okay. And QQQ, the plain index ETF over the same period.
QQQ's cumulative return, around 28%.
Whoa. Okay. 14% versus 28%.
Yep.
That's a 14 percentage point difference in total return for less than 3 years. That's significant.
It really is. And it's a direct result of the strategy.
How so?
During those tech rallies we saw in that period, JPQ's structure, selling those calls, meant it capped a lot of the potential upside.
While QQQ just wrote it up.
QQQ captured it fully.
So the performance really bears out the theory. You basically paid for that higher 11% current income by giving up quite a bit of potential total return compared to just owning the index.
That's the core trade-off. One source used a really sharp analogy for this.
What was it?
It's like a payday loan for your portfolio. You get cash now, but it costs you more down the line.
Wow. A payday loan for your portfolio. That really highlights the potential long-term cost, doesn't it?
It's stark, but it's a powerful way to think about it. High current income doesn't magically appear without impacting potential long-term wealth.
Okay. Now, another angle. People often get drawn to covered calls because they think, oh, regular income must be safer, less volatile. It sounds stabilizing.
Yeah, that perception is common.
But the sources kind of throw some cold water on that.
Yeah, do. They acknowledge that JEPQ's measured volatility is lower than QQQ's.
Okay, so it is a bit less bumpy.
A bit, but they're careful to say it's not by a wide margin.
So it doesn't suddenly turn into, like, a bond or something low risk?
Not at all. You have to remember, it's still heavily invested in volatile tech stocks.
Right. Underneath it all, it's still the Nasdaq.
Exactly. It is absolutely not a bond substitute when you look at the risk profile. And the downside risk, that's still very real.
Meaning if the tech market tanks, like that pullback in late 2022, or just any risk-off event.
JEPQ still falls. The sources emphasize that. And during those sharp drops, the income strategy actually provides less protection than you might hope.
Less protection? How come?
Well, often when markets fall sharply, volatility can sometimes decrease after the initial panic, which shrinks option premiums. So the income buffer gets smaller, while the hit from the falling stock prices remains.
Ah, okay. So while it might offer, what did one source say, a little cushioning?
Yeah, a little cushioning, but you're definitely not getting true downside protection from a market crash.
Good to know. Not a safety net.
The core risk of owning tech stocks is still there.
Okay. Another really crucial point the sources brought up, and one I think people easily overlook when they see that big yield number.
Taxes.
Taxes, exactly. That 11% yield has a hidden drag for a lot of investors.
Yes, absolutely. Because that income, that 11%, is mostly considered non-qualified income.
Mostly non-qualified, which means...
It means it's taxed at your ordinary income tax rate.
Okay, not the special lower rate for dividends or capital gains.
Correct. Not the lower qualified dividend rate or the long-term capital gains rate. And for many people, especially those in higher income brackets, that ordinary income rate is significantly higher.
So for investors in those higher tax brackets, the sources say it can be a real killer.
It really can diminish the appeal. The sources gave a clear example. If you're in, say, a 35% federal tax bracket, that 11% gross yield turns into a net yield of only 7.15% after federal taxes, maybe even lower with state taxes.
Wow, that's a big haircut.
It is.
Wow.
Compare that to qualified dividends or long-term gains where you might keep 80% or 85% after tax. The difference in tax efficiency is substantial.
So what's the strategy then? The sources recommended something specific.
Yeah, they strongly suggest avoiding holding JEPQ in a regular taxable brokerage account if you're in a high tax bracket.
Where should you hold it then?
It's best held in tax-advantaged accounts like IRAs or maybe a 401k if possible, places where that income isn't immediately taxed each year.
So you defer or avoid the tax hit that way.
Exactly. That allows the investor to potentially benefit more from that high gross yield without the immediate tax drag.
Okay, that makes a lot of sense. So pulling all these pieces together, now the yield source, the growth trade-off, the actual performance, the volatility reality, the tax bite, who, based on our sources, is JEPQ actually a decent fit for? And who should probably steer clear?
Yeah, the sources give some pretty clear guidance on suitability. JEPQ can be a good tool for a few groups.
Like who?
Like retirees who genuinely need that current monthly income for living expenses and maybe want to avoid selling shares periodically.
Okay, income-dependent retirees.
Also, investors holding it within those tax-sheltered accounts, like an IRA, specifically targeting high cash flow generation within that account.
Makes sense, given the tax issue.
And finally, what one source called risk-tolerant income chasers.
Risk-tolerant income chasers.
Yeah, basically people who fully understand and accept that opportunity cost.
Yeah.
They know they might lag in strong growth markets, but they prioritize the high current income anyway.
They're okay with giving up some potential total return for that income stream.
Exactly. They've made that conscious choice. Now, who is it not ideal for?
Yeah. Who should avoid it?
Well, pretty clearly, growth-focused investors whose main goal is long-term total return. This isn't designed for that.
Right.
Also, as we just discussed, taxable account holders in high income tax brackets because of that non-qualified income problem.
Yeah, absolutely.
And frankly, anyone who just sees the 11% and thinks it's some kind of free lunch or comes without any significant trade-offs, it absolutely does come with trade-offs.
That framework seems really logical based on everything we've discussed. Now, because JEPQ often gets mentioned in the same breath as its older sibling, JEPI.
Yes, the comparison.
The sources touched on that too, right? How do they stack up?
They do. They share that core strategy, owning stocks and selling calls for income.
Right.
But they focus on different things, leading to different risk and reward profiles.
Okay, so what are the key differences the sources highlighted?
Well, focus, obviously. JEPQ is Nasdaq 100, so very tech and growth heavy.
Right.
JEPI is S&P 500, much broader, more diversified across different sectors.
Okay, different underlying basket of stocks.
Yeah.
What about yield and risk?
JEPQ typically has the higher trailing 12-month yield, that 11% we've been talking about. JEPI's is usually lower, maybe in the 7-9% range, depends on the market.
And volatility.
Because of that tech focus, JEPQ is generally higher volatility. JTPI, being more diversified, tends to be lower volatility.
And growth potential.
Theoretically, JPQ has more potential upside if the tech sector really takes off, just because its underlying index is more growth-oriented.
Right, the Nasdaq versus the S&P.
KGPI's potential upside is generally seen as lower, more muted.
So JPPI comes across as the more conservative option of the two.
That's generally how it's positioned, yes. More conservative, lower yield, lower volatility, more diversification. JEPQ offers potentially more yield and maybe more upside in the right market.
But with more risk.
but with more volatility and concentration risk. It really is a choose your risk appetite kind of decision between them.
Got it. Choose your flavor of covered call ETF. Lastly, the sources mentioned one other path, right? An alternative for someone who maybe likes the idea of selling calls for income, but wants more control.
The DIY approach. Doing covered calls yourself.
Right. What does that involve?
Basically, it means you'd buy the underlying stocks or ETF yourself. Maybe you buy QQQ or shares of Apple or whatever tech stocks you like.
Okay.
And then you actively sell the call options against those holdings yourself using a brokerage account that allows options trading.
Okay. What are the pros and cons of doing it yourself, according to the sources?
The main potential pro is control. You get to pick the exact strike prices you sell at, the expiration dates.
More customization.
Exactly. And you might have more flexibility in managing the tax side of things, although that definitely adds complexity.
Yeah, I bet. What are the downsides?
Yeah.
Sounds like work.
It is work. The downsides are significant. First, you absolutely need to understand how options work. That takes education and effort.
Sure.
Second, you have to actively manage and monitor your positions. Options expire. Things need rolling forward.
It's not passive.
Not at all. And then there's the admin dealing with potential early assignments if your stock gets called away, keeping track of everything for taxes.
Yeah.
It's hands-on.
Okay, so JEPQ is kind of presented as the hands-off way to get this strategy exposure.
It is, for many people, that's the appeal. Convenience. But the sources offer that reminder, convenience has a cost.
Right, not just the fee.
Not just the fee.
Yeah.
You pay for that management and simplicity, potentially, by giving up that direct control and customization you'd have doing it yourself.
Okay, that's a good perspective. So let's try and pull all these threads together now. What's the ultimate bottom line we take away from this deep dive into the sources on JPQ?
I think the main thing is that JEPQ's 11% yield it's not a scam, but it's also not magic. It's the result of a specific calculated income strategy, mostly selling call options on Nasdaq stocks.
And it's a strategy that, as the sources said, works best in sideways markets.
Right, or for investors who are really prioritizing that high current cash flow over trying to maximize their total long-term growth.
And this seems like the most critical takeaway repeated everywhere.
The cost is real.
The cost is real. What are those costs again, summed up?
Okay, number one, capping your potential upside during strong bull markets.
Yeah.
You'll likely lag.
Okay, number two.
Tax inefficiency. That non-qualified income can really hurt your net return if you hold it in a regular taxable account, especially in higher brackets.
Got it. And number three.
Limited downside protection. It still goes down when the market drops. It's not a safety net, just maybe a little cushioning.
Okay. Capped upside, tax drag, limited protection.
Those are the big ones. So the conclusion from our sources seems to be, in the right hands, JEPQ is a powerful tool, but like any tool, it can cause damage if misused.
You really need to understand what it is and what it isn't.
Exactly. It really boils down to knowing yourself as an investor. What are your goals? What's your risk tolerance? What's your tax situation? Understanding what you're actually buying with JPQ and making sure those two things align.
So bringing this all back to you, our listener, hopefully this deep dive helps you look at JEPQ or any high-yield product with clear eyes beyond just that, admittedly attractive 11% number. It really prompts some crucial questions you should ask yourself. Questions drawn right from the source material we reviewed. Do I really understand what I'm giving up to get that 11% income right now?
Yeah, the opportunity cost.
Am I genuinely okay with the real possibility, even likelihood, of underperforming a plain index fund like QQQ when the market is strong?
That's a big one.
And maybe most fundamentally, do I genuinely need this specific level of income today? Or am I just kind of falling for the headline yield without fully weighing those trade-offs?
It's so easy to get drawn in by the big number. Navigating investments today with just information overload. It's tough.
Yeah.
But understanding these mechanics, the trade-offs, like we've tried to distill from the material today, that's absolutely essential, I think. It helps you make informed decisions that fit your actual needs and your circumstances.
Instead of just chasing yield.
Instead of just chasing the highest number you see advertised.
Okay, so here's a final thought for you to maybe mull over as you go about your day building on all this. Thinking about JEPQ's structure, how does that pursuit of high income right now potentially conflict with maximizing your total return over the long haul?
Good question.
And more personally, for your financial situation, which one of those matters more? Income now or total return later? Or maybe, now that you understand how a product like JEPQ actually generates its yield by selling upside, How does that knowledge change the way you look at any investment that's advertising a remarkably high income stream? Something to keep in mind.